Hello, welcome to Any Answers Answered for July 2017. This month we're going to continue what we were doing last month, which is have a little look at a couple of the P11D issues facing people as we approach the deadline. Watch it quickly, otherwise you'll have missed the deadline for this year, but still relevant stuff. This time both questions are to do with cars, and the first question is, it's a fairly common story, I think. Somebody has decided they found the employee they'd like. The employee really wants to have a company car as part of this, actually because of the commute to work. The commute to work is so long, no real business mileage, so to speak, just that commute to work. However, the costs of the car, the cost of the fuel benefit, the cost of all of these different bits and pieces are adding up to a figure that isn't massively popular with the employer, very unpopular with the employee. And so the employer is saying, is there anything we can do about this? How can we structure this to make it a much cheaper option for the individual? And I think, Tim, the answer is going to be move the office or find a different employee.
I think so. And first thing I would say is that the individual who put this onto accountingWEB is, I think, the owner of a small business and is not an accountant, and they're trying to get a bit of free advice from accountants who are on accountingWEB. Now, there's nothing wrong with that, and from time to time we do get postings of that nature. But the answers coming in from the accountants are pretty unanimous in the view that you shouldn't be providing this new employee with a company car in this sort of way. And the suggestion is that it's going to be a second-hand car that'll generate a benefit in kind of about £5,000. On top of that, the employer is suggesting that they'll split the petrol costs 50-50, and that'll generate a fuel benefit of another £5,000. So the total tax for the employee will be about £3,000. They don't mention it, but there'll be secondary class one, of course, for the employer. Now, the answer, I think, is that the employee should be persuaded to provide their own means of transport and, if necessary, offer a higher salary. There's certainly no tax benefit, there's a tax disadvantage in the proposed arrangement. And as a couple of the accountingWEB responders to this query say, actually, with a brand new employee like that, you're crazy spending money on a car, albeit a second-hand car costing 10 grand, because they may well decide after a couple of weeks or a month or so of commuting 75 miles each way that it's not for them and they disappear. And the company is then left with a second-hand car that's got no use for it, it'll have lost that money as well. So it's a good example of where we shouldn't let the tax tail wag the commercial dog. What the original poster does suggest is the possibility that instead of a company car, they make an interest-free loan to the employee of, say, 10,000. So that's probably the amount of the price of the second-hand car, so that the employee can then buy the car themselves, and they then recover the interest-free loan by deduction from monthly salary. But again, you're risking the employee chucking it in after a couple of weeks, and they've then got that loan outstanding.
And at 10,000, of course, it's worth pointing out the beneficial loan wouldn't be there because it is 10,000. So it's not any more than that, and they would have problems.
I'm sorry, I missed your point. Of course, the 10,000 is the threshold for the benefit on the interest being tax-free. So yeah, you're right. That's probably why they've chosen that figure.
Yeah, okay. But the point is, realistically, you're going to have some cost however you do it, and the answer is if you can avoid having the asset at the end, that has to be the best advice. But in terms of pure tax, a perfect example of how a company car sounds a lovely little idea until you start to really look at the maths, and it really can be a very expensive benefit still, unless you are very fortunate. The second question we've been asked, this one is from Andrew119, and he asks, again, a fairly standard question about company car versus car allowance. Is there a tax implication? Can I still pay 45p a mile for the person if they've bought their own car, having had the car allowance, etc., etc.? Obviously, I would like you to answer the question, but as well as that, we need to talk about salary sacrifice, which has a huge implication. The new rules have a huge implication on exactly this scenario.
Yes, and these are very important changes for certain benefits in kind, and the salary sacrifice rules, or more properly, the optional remuneration arrangement rules, were included in the Finance Act 2017. and took effect from the 6th of April this year. So current benefits in kind need to be reviewed in the light of the new optional remuneration arrangement rules, and the provision of cars is a good example of a benefit that could well be caught. And let me give you the example that I trot out in the lecture room on this. Suppose the company offers an employee a company car with a cost of £30,000 and it's a hybrid emitting 115 grams per kilometre. Not 150 grams of CO2 per kilometre, you know what I mean. And that car is first provided at the start of this tax year, and the intention is to provide it for 4 years. The calculation of the benefit will give an increasing charge, as the benefit will go up from 22% this year to 24% next year and so on. And the calculated benefits under that percentage of list price calculation would be 6,600 in year one, 7,200 in year two, then 8,100, then 8,400. So those are the amounts, 66728184, on which the employee would pay tax. But if that employer has a scheme whereby they say to managers at a certain grade, you can either have a company car of this value or you can have additional salary. So they offer a car allowance. And let's suppose that that particular employee who is offered the car costing 30 grand, etc., is offered as an alternative an extra 7,500 a year salary. Now, in previous years, the employee that takes the car is simply taxed on the car benefit. And the employee that takes the cash allowance is simply taxed on the additional 7,500 cash allowance under PAYE. But this year, if the employee takes the car, then we've got to work out the benefit in kind using the higher of the car allowance, the alternative cash, or the traditional benefit. And so without the car allowance on the table, the benefit would have been 66728184, but with the car allowance in place, the benefit becomes 7,500, 8184, because in the first 2 years the car allowance is higher than the computed benefit. In the second 2 years it falls away because the benefit has gone up. And that's a hugely important point, not least because a lot of employers are now processing the benefit in kind by notifying the revenue during the tax year so that the revenue can adjust coding. Well, if they don't take into account the car allowance, they will be misreporting and understating the benefit, and that will then have to get sorted out at a later date.
And as you say, it could go in either direction. It could be that somebody thought, well, I've got a really environmentally friendly car, so I'm going to be much better off taking the car than the cash. No, it'll be the higher figure. Equally, I'm much better off taking the cash because it's a beast of a car and it's going to have these huge figures. Doesn't matter. It's the higher figure if you are given the choice. So,
well, let me just say there that the optional remuneration arrangement rules, the salary sacrifice rules in shorthand, don't apply to the major exempt benefits like childcare vouchers, pension contribution, cycle to work scheme, and they don't apply to ultra low emission vehicles. So cars emitting below 75 grams of CO2 per kilometre, we wouldn't need to worry about the car allowance. I say that because you mentioned
so you're quite right.
Whereas in my example just now, it was emitting 115, so that's not ultra low emission, so that would get caught.
Okay, so a low emission, but say 76 grams per kilometre would be caught, but actually the other way around, I'd rather have the cash. No, you might as well have the car in some situations.
A further point, while I'm in full flood on this, is that if the same car had been provided on the 5th of April, where there was a cash allowance alternative, the new rules wouldn't apply until the employee changes that car for a different one or 2021. So there's a 4-year grandfathering period for benefits in place before 6 April 17, but that expires if you change the basis on which the benefit's provided. So that would include changing a car.
And as things are changing in cars, I suspect by 2021, a lot of people will be going for the ultra low emission cars.
Oh yes, I hope so.
So quite possibly that will be the resolution there. hopefully useful. Next time Tim and I are talking to you on Any Answers, it will be the beginning of September. Have a wonderful summer. Do keep writing your questions, and perhaps next time it'll be your question that we're answering. But for this time, bye-bye.